Interest rates and how they are set by the Fed. Ever since the financial crisis, interest rates have been near zero, making it cheaper for everyone to borrow, from banks to homeowners to car buyers. However, as the economy strengthens, the Fed will want to raise interest rates to prevent the economy from overheating. Some of the techniques the Fed used to manage rates in prior decades no longer function, so the Fed has designed a new tool set to push rates up and hold them in the proper range. Anyways, hey everyone, welcome to our channel. In today's video, we are going to talk about interest rates and how they are set by the Fed, and would answer some questions like, what is the interest rate and what is the federal funds rate? Stick with us to the end of the video so you don't miss anything. Make sure you like and share our video and subscribe to our channel. Without wasting any more of your time, let's jump into the video and talk about what is an interest rate. Well, an interest rate is either the cost of borrowing money or the reward for saving it. It is calculated as a percentage of the amount borrowed or saved. You borrow money from banks when you take out a home mortgage. Other loans can be used for buying cars, boats, or paying off education. Banks borrow money from you in the form of deposits, and interest is what they pay you for the use of the money deposited. They use the money from deposits to fund loans. Banks charge borrowers a slightly higher interest rate than they pay depositors. The difference is their profit. Interest rates remain within a narrow range because banks compete for both depositors and borrowers. An interest rate is the percentage of principal charged by the lender for the use of its money. The principal is the amount of money loaned. Interest rates affect the cost of loans. As a result, they can speed up or slow down the economy. The Federal Reserve manages interest rates to achieve ideal economic growth. Now let's move to another question. How exactly interest rates work? The bank applies the interest rate to the total unpaid portion of your loan or credit card balance, and you must pay at least the interest in each compounding period. If not, your outstanding debt will increase even though you're making payments. Although interest rates are very competitive, they aren't the same. A bank will charge higher interest rates if it thinks there's a lower chance the debt will get repaid. For that reason, banks will tend to assign a higher interest rate to revolving loans, such as credit cards, as these types of loans are more expensive to manage. Banks also charge higher rates to people that they consider risky. The higher your credit score, the lower the interest rate you will have to pay. Here's how the Fed sets interest rates and how that rate has changed over the last 4 decades. But first, what is the federal funds rate? Central to the Fed's power is its ability to affect how much banks charge each other for lending money on an overnight basis, known as the federal funds rate. The Fed doesn't have the authority to mandate and enforce a particular federal funds rate, so it's forced to influence the money supply to move interest rates toward its target range, currently 2.25% to 2.5%. The more money the Fed pumps into the economy, the more cash available for banks to lend, and the lower interest rates fall. That in turn affects how much banks charge individuals and businesses to borrow. At their core, banks turn profits by lending money at a higher interest rate than at which they borrow from depositors or other financial firms. Thus, when the Fed forces banks to pay more to lend to each other, it tends to affect how much banks charge everyone else for auto loans, mortgages, and a host of other debts. So effective are the Fed's adjustments to the money supply that many economists and financial outlets use shorthand when writing about the central bank's decision-making by simply saying it raised or cut interest rates. Here's what you can do to prepare for the coming rate hike. As the central bank lays the groundwork to raise interest rates this year, customers will see their borrowing costs rise as well. Deposit rates won't be as quick to respond. And here's what you can do to prepare. Savers get squeezed. When the Fed does raise its benchmark rate, deposit rates will be much slower to respond, and even then, only incrementally. While the Fed has no direct influence on deposit rates, they tend to be correlated to changes in the target federal funds rate. As a result, the savings account rate at some of the largest retail banks has been hovering near rock bottom, currently at a mere 0.06% on average. The central bank for the United States, the Federal Reserve, or the Fed, is tasked with maintaining a certain level of stability within the country's financial system. Specific tools are afforded the Fed that allows for changes to broad monetary policies intended to implement the government's planned fiscal policy. These include the management and oversight of the production and distribution of the nation's currency, and sharing of information and statistics with the public, and the promotion of economic and employment growth through the implementation of changes to the discount rate. The most influential economic tool the central bank has under its control is the ability to increase or decrease the discount rate. Shifts in this crucial interest rate have a drastic effect on the building blocks of the macroeconomics, such as consumer spending and borrowing, overnight lending, and bank reserves. Banks are required by the Fed to have a minimum number of reserves on hand, which is currently set at 0% in response to the 2020 crisis. Previously, the rate was set at 10%. 1%. This meant that a bank with $1 million on deposit had to maintain at least $150,000 on reserve and was free to lend out the remaining $900,000 to borrowers or other banks. Each day, bank reserves are depleted or augmented as customers carry out day-to-day banking and make payments, withdrawals, and deposits. At the end of the business day, if more withdrawals have been made than deposits, the bank may have found itself with too little reserves, say just $50,000 left, and would have been below regulatory requirements. It would then have had to borrow the other $50,000 overnight as a short-term loan. If another bank saw more deposits than outflows, it may have found itself with perhaps $150,000 available, and so could lend $50,000 to the first bank. It would prefer to lend those excess reserves and earn a small amount of income on it rather than to have to sit idly as cash earning zero yield. The rate at which banks lend to each other overnight is called the federal funds rate, or Fed funds rate for short, and it is set by the supply and demand in the market for such short-term reserves loans. Decreasing interest rates. When the Fed makes a change to either their Fed fund rate, economic activity either increases or decreases depending on the intended outcome of the change. When the nation's economy is stagnant or slow, the Federal Reserve may enact its power to reduce the discount rate in an effort to make borrowing more affordable for member banks. When banks can borrow funds from the Fed at a less expensive rate, they are able to pass the savings to banking customers through lower interest rates charged on personal, auto, or mortgage loans. This creates an economic environment that encourages consumer borrowing and ultimately leads to an increase in customer spending while rates are low. Although a reduction in the discount rate positively affects interest rates for customers wishing to borrow from banks, consumers experience a reduction in interest rates on savings vehicles as well. This may discourage long-term savings and safe investment options, such as certificates of deposit or CDs, or money market savings accounts. Increasing interest rates. When the economy is growing at a rate that may lead to hyperinflation, the Fed may increase interest rates. When member banks cannot borrow from the central bank at an interest rate that is cost-effective, lending to the consuming public may be tightened until interest rates are reduced again. An increase in the discount rate has a direct impact on the interest rate charged to consumers for lending products, and consumer spending shrinks when the tactic is implemented. Although lending is not as attractive to banks or consumers when the discount rate is increased, consumers are more likely to receive more attractive interest rates on low-risk savings vehicles when this strategy is set in motion. The bottom line? The Fed, like all central banks, uses interest rates to manage the macroeconomy. Raising rates makes borrowing more expensive and slows down the economic growth, while cutting rates encourages borrowing and investment in cheaper credit. All of this ripples out from the overnight lending rate that banks must utilize in order to maintain the required reserves of cash, which is also set by the Fed. And that's all for today, guys. Enlighten us with your thoughts, share them in the comments below, and don't forget to hit subscribe to our channel and ring the bell icon for more amazing videos. And thank you for watching.